Hello, and welcome to this latest Renegade Investor Report with me, Graham Rowan. And today I'm asking the question, what's gone wrong with gold? We seem to have had the perfect setup for the yellow metal, but it just isn't performing. So let's take a more detailed look at what's going on and just see if we can make any sense of this. But just to remind you who Renegade Investor Report is for, it's really for established investors and business owners trying to build and preserve wealth in these kind of crazy times of the 2020s. I can never remember a period like this. So it's never been harder to do that. So, what we're going to try and do here is become one of your trusted sources of information so that you can make sense of what's going on and hopefully make the right decisions. If you're relatively new to investing and you're trying to avoid some of the mistakes you've seen other people make, then obviously we'll also try and encourage you and give you the sort of start that gets you off to the flying start you need to build some wealth as you go forward over the coming decades. And also, I have to say that, I'm very much here for those who share my view about the increasingly worrying scale and size of government intervention in our lives. It's clear in the last 18 months with everything that's gone on with the banana situation that these guys are becoming more totalitarian by the minute, and they think that they can just make rules and laws at whim, presidential type decrees, and obviously we're also starting to see the first of the increased taxes coming through to pay for it all. So there's going to be an awful lot of challenges, but also an awful lot of opportunities this decade. And I want to be here to try and help you exploit the opportunities and somehow manage the risk of all those downside challenges. The Renegade Investor Report is brought to you by the Beaufort Society. They're a private members club for sophisticated and high net worth investors. They have things like their property connections service, where they introduce you directly to carefully selected property developers if you want to become a joint venture partner. And they also have a portfolio of interesting alternative investments. You can learn more about them and you can join. There's no charge to join at beaufortsociety.com. And also by Crypto for Grown-Ups, which is a program I'm running with the sector specialist Dee Ludlow to try and get more mature investors into this world of crypto, because I think it represents probably the biggest opportunity of our lifetime. There's plenty of hype in this space already without me adding to it, but I really do believe that it's what the professionals call an asymmetric opportunity, but the ownership amongst the over 40s is so small at the moment. I think it's either through fear or ignorance or just inertia and resistance to change. But if you go across to cryptoforgrownups.co.uk, you can learn more about that program there and see whether it could be helpful for you. If you've never heard of me, why should you bother listening? Well, I'm no claims to be a great guru. All I can talk about is my own experience. I've been managing my own investments for 20 years now, since my professional wealth managers lost me over £150,000 in the previous NASDAQ boom and bust, and then fired me for having too low a net worth. That was the point at which I took control of my own finances. And since then, I've spent a lot of time studying this area, writing books about it. I've presented a number of TV series on Sky, met some amazing people like Jim Mellon, the biotech billionaire, Jim Rogers, and all the people that I interviewed on the Money and Me series, which you can see in my latest book. So really what I try and do is to take some of the complexities of what's going on in the kind of macro environment of economics and politics and investment and convert that into actionable strategies that the people can actually do and get benefit from. So that's what I'm all about as Renegade Investor. So let's have a look at this week's subject matter. I've been a long-term gold investor. It's one of those things where it always feels to me like something real. Most of what we invest in, they're pieces of paper or increasingly now digital assets. And so there's something comforting, a bit like, I understand a lot of you are property investors and you get that comfort from bricks and mortar. But for me, there's nothing that makes you feel more wealthy than having a safe full of gold bars or gold coins or something like that. It's something that's got thousands of years of heritage, and thankfully politicians and central banks can't mess with it. Mind you, they used to mess with the coins. They used to clip those to try and effectively debase the currency back all the way to Roman times. So there's nothing new about currency debasement. It's just how you do it. Clue it's actually going on, and they're being robbed every day by their politicians and central banks. So gold is one of the antidotes to that, if you like, and certainly the longest established store of value as your pounds or your dollars or your euros disappear and evaporate into thin air week by week. Normally, there are certain situations where gold you'd expect to be favorable and others which are not favorable to gold. We are in a phase where you would think we were rolling out the red carpet for gold and for gold miners, the people who produce it. But it just isn't happening. And I am baffled by this. I mean, look at American inflation figures at the moment. It's zooming up. The stock markets are reaching new highs almost every day. Bond yields are falling because the prices keep rising. So, if you can't earn decent income from stocks and share dividends or from bond yields, then the penalty, the price of holding gold, what Warren Buffett calls this barbarous relic because it doesn't do anything or pay any returns, if the returns you can get are close to zero or even negative, then the penalty for gold disappears. All the benefits are still there in terms of long-term store of value, ease of storage and portability and all those kind of things. And yet, if the penalty is not there, why isn't it becoming more attractive? Real earnings yield plus the dividend yield of the S&P 500 are in negative territory for only the second time in 75 years. So with negative yields from the stock markets and the bond markets, gold should be rip-roaring into the sky in price, and it's stuck in this range of $1,700 to $1,800. It briefly touched a new high around $2,000 a few months ago, and since then it's been kind of stuck. So I don't know why. It's a complete mystery to me. So let's have a look at some of the statistics and the charts and see if they help us at all. As I say, US inflation right up there north of 5%. Obviously, the Fed and all the other central banks are very much trying to convince us this is all temporary. It's just coming out the other end of the banana situation. That's just to be YouTube friendly in case you think I've gone completely mad. These algorithms are getting smarter and smarter. So we've got this enormously high inflation. I think it's the highest since certainly before the financial crash of 2008. And it looks at the moment like it's stubbornly here to stay. It's not as transitory as they would like us all to believe, but we'll see. Average wages, getting mixed data on this, certainly in the manufacturing sector, as you can see, they've been starting to climb. And obviously, as people see prices rising in the shops, they're demanding higher wages. Look at the bonuses being offered to lorry drivers now. Look at McDonald's paying for people to turn up even just for an interview, let alone to actually come and do some work. So labor is scarce, especially in areas that were hit by the banana situation in hospitality and events and so on. A lot of people have either got other jobs or they've moved abroad or they've decided they don't particularly like working and they want to keep getting their furloughs and their stimmy checks. So wages to actually get people to turn up and do a job are increasing. And then let's look at the effect on the stock market. We've had a low inflation for a best part of a decade now with financial repression and 5,000-year low interest rates. That's been great for the technology shares, effectively those that didn't really pay much in the way of dividends anyway. Their earnings multiples have been going up very much in this kind of period of low inflation. And so you've just seen them skyrocketing, you know, all the FANGs, all the famous tech stocks. They've really gone to incredibly high multiples. And, you know, there are those who think that that's going to continue simply because of the convergence of all these different technologies at one time in history, whether that's AI and robotics, whether that's new agrarian technologies, whether it's healthcare, whether it's space travel. You know, there's all these sectors coming together, big data, 5G, and all the rest of it. So those shares have been absolutely skyrocketing. Now, conventional wisdom would have it that as inflation takes off, that should change and there should be a switch into more kind of value-based stocks. We saw a little bit of that earlier this year, and then it's kind of petered out and we've gone back to the massive growth in the tech stocks again. So that's how the NASDAQ has compared. And obviously I have mixed feelings, having been a bit of a victim of the previous NASDAQ boom and bust. So that's how NASDAQ's been doing. And it's a similar story with the S&P 500. Look at the green curve there versus consumer price index. Steady rise in CPI, but a massive rise since the financial crisis. The S&P has been on an absolute tear. And also, I think the interesting thing on this chart is how the US dollar has held up. Now, so much has been made of all the money printing. Was it 25% of all dollars have been created in the last 12 or 18 months? But it hasn't collapsed. Why? Because everyone else has been doing the same thing. And it's all relative. The dollar is not the best currency. It is the least worst currency in the eyes of the markets. And at the moment, that situation is continuing and may well continue for some time yet. I think that the death of the dollar has perhaps been slightly prematurely predicted, but it is certainly holding its own as all the other currencies get debased in equal measure around the world. Great news for us if we're savers, of course, relying on income and relying on that currency. And look at this, the spread between the 10 and 2-year US treasuries. These are important numbers. The 10-year treasury, probably one of the most important stats you can follow. We've had situations where, bizarrely, you've been offered a lower interest rate on a 10-year treasury than on a 2-year. If you look at the bottom of the chart here, back in 2019, it just went slightly negative there. That's called an inverted yield curve. Normally a yield curve should go up. In other words, the longer you commit your money for, the more you should be paid in interest. Seems reasonable. But when things start going a little bit awry in the economy, and this is a clear indicator of it, you sometimes get this inversion where for some reason the long term actually gets cheaper than the short term. Now look what's been happening recently. It's almost like we're heading back towards inverted territory. The longer term yields have been coming down. And there's an argument that says the only way you can stimulate more activity in the real economy is if interest rates become even lower. One of the challenges has been, there's been a lot of stimulus cash floating around, a lot of savings from people who've been under house arrest for 18 months. And there's all this cash sloshing around, and it's not being invested. It's not being, companies have not been investing. This is a long-running trend where they've been relying on cheap labor rather than new technology, and that, to motivate them to invest in producing more higher productivity and therefore potentially less reliant on cheap labor, requires loans to become cheaper, which means longer term interest rates come down. Now, that would be I suppose, the natural trend in the market. Obviously, what we've seen in the last 12 or 18 months is massive manipulation of the treasuries markets by central banks. And when the Fed is doing all the buying, clearly that's going to suppress the yield curve. That's going to keep interest rates or yields low because they keep buying and buying and buying, and there are only so many treasuries to buy. The prices keep going up. the amount you're paid on that treasury is fixed from the point it's actually initially launched. So you're only ever going to get, 1.2% or whatever it is. And as the price goes up, the cash amount stays the same. So in percentage terms, that yield comes down. So when you hear on the news that bond yields have risen, that usually is bad news. It means prices have fallen. If bond yields have fallen, it means prices have risen. But the demand is entirely artificial at the moment, coming from the Federal Reserve, effectively an arm of government now funding Joe Biden's spending programs by buying his government bonds and putting them on the Fed's balance sheet. If you and I did this in our businesses, we'd go to jail. But when politicians and central banks are in collusion doing this, it's not called fraud, it's called fiscal and monetary policy. So there you go. That's what's going on at the moment. And we see this significant fall in 10-year yields, almost heading towards the danger of an inverted yield curve. And the tips, these are the Treasury inflation adjusted or protected treasuries. So these are like inflation protected gilts in the UK. And of course, the yields on those has been going down and down and down, and the real yields are now in negative territory. So you are guaranteed a loss if you give your money for 10 years to the American government, which is obviously great for them because it means their cost of borrowing has never been lower. It's truly awful for us as investors and savers because it means the return on those kind of treasuries and government bonds has never been lower. And with any kind of real inflation measure, even the hugely manipulated things like CPI, you are now taking that 2, 3, 4, 5% from these very low yields to start with. You are clearly in negative territory. So you're losing money on government bonds. Stock market yields, the other place you'd go to search for yield, dividends on shares, are also as low as they've ever been. Now, there's a lot here on this chart. This is a 5-year cyclically adjusted earnings yield. And really, the things to look at are these red dots down here, because what they're showing us is the earnings got very low in 1929 before the crash, again just before the Second World War, again in my old friend the tech bubble, and look where we are now. And the historical point to bear in mind here, and this is the other side of the argument compared to those people saying that this is the exponential age and this tech stuff's going to continue rising forever. This is 100 years of history, and it's saying that when we've been in this position in the past, then bad things have happened. And if you look in the bottom right-hand corner here, you'll see the subsequent performance of the S&P 500 down 84% over 3 years after the Wall Street crash, down 51% in 5 years after the 37 peak, down 43% in 3 years after the tech bubble. So if you followed the lessons of history, you'd say that we are heading for a major correction, if not a crash, in the S&P 500 and presumably the NASDAQ based on these earnings yield figures. So, those people that are still piling new money into these markets, just a note of caution that it could go on a long time. We all know the old adage that, the markets can stay irrational longer than you can stay solvent. But, study that chart, study history, and ask yourself, how much new money you want to be putting into that, very, very hot tech stock market at the moment. Now, this is interesting, the commodities to equities ratio. In other words, how are commodities, real stuff, whether that's agricultural stuff, whether that's metals, obviously precious metals and things, how are they doing compared to shares? And how are they doing compared to inflation? Well, as you can see here, the blue chart is commodities. The white chart is US CPI inflation, which obviously has just taken a huge spike. And also commodities are a really low value relative to shares. So if you're a believer in reversion to the mean, which most things have seemed to do over history most of the time, then you would say that with The stock market's at record highs in terms of prices and record lows in terms of yield, and with commodities at record lows or 50-year lows against equities, you might feel that we were coming into a phase where commodities were going to see some increases in prices and maybe shares were going to see a correction. It may not happen, but again, you just got to point to the weight of history and the tendency of things to sort themselves out and come back to some sort of average over time. Commodities are at a 50-year low against equities. Equities are at all-time highs. Equity yields are at 75-year lows. Put all that data together. What do you reckon? And again, I come back to my whole message of this report. Where is gold in all of this? This is the perfect setup for gold to absolutely skyrocket, but it ain't happening. Who said this investing malarkey was easy? And here's gold against real interest rates. Obviously, interest rates are a core driver of gold prices because the penalty for holding gold is you don't get any interest rate. So the lower interest rates go, the less that penalty becomes, therefore the more attractive gold becomes. So if you have a choice between government bonds, which are A, negative in real terms, and B, paying you in the ever more debased dollars, pounds, or euros that the central banks and politicians are actively, deliberately debasing. They are deliberately keeping interest rates below inflation. This is called financial repression. We touched on this in a previous report. So they know they're robbing you deliberately. And gold, again, should be doing well here. Now, one of the ways of looking at this is, what if you recognize that we live in a time of inflation, but you simply can't find assets that are going to pay you enough in percentage and cash terms to keep yourself up with or even ahead of inflation? So you can't do it through dividends on shares because they're at record lows. You can't do it through government bonds because they're in negative territory. So they're both failing to keep up with inflation. One other strategy you could deploy is to put your money into hard commodities, which just by the nature of their price going up in times of shortage or in times of inflation should protect your earning power more than going into a guaranteed loss with shares or a guaranteed loss with bonds. So the idea here is not that you're actually going to get paid. If you buy gold or silver or corn or wheat or whatever, you're not going to get paid interest on that money. You just own the thing. You own the commodity. But as prices go up in the shops, as prices go up enormously at the purchasing managers for manufacturing index, you should get protection because the price of the thing you own should at least go up in line with inflation. That is the argument. And gold normally goes up as interest rates and bond yields fall. So we are in what should be a perfect setup for gold. But even if you're simply thinking, what can I invest in that might hold its value with inflation, even if it doesn't actually pay me a coupon that matches the 5.4% inflation in America, for example? The argument here would be buying physical stuff that should go up in price in line with inflation. And here's some interesting news. If gold is such a useless relic and we're all doing other things now and it's part of some ancient system that's had its day, why are central banks buying more of it? They're the ones that are actively debasing their own paper currencies, and at the same time, they're buying more of this ancient relic. Interesting. I always think it's useful to look at what people actually do rather than necessarily what they say. So foreign demand for US treasuries, hardly surprisingly, is declining because that market is being so manipulated by the Federal Reserve buying so many of them, pumping the prices up and the yields down. If I'm a foreign country or a foreign company, why on earth would I want to buy those? It's a crap investment. The Fed is becoming this buyer of last resort. They're just underwriting everything that Joe Biden does. And so they are locked into this spiral, this vicious spiral of having to keep on debasing the currency, keep on buying bonds and hoping it'll all turn out well in the end. I mean, what could possibly go wrong? Gold did actually have quite a quick run up in 2018 through to 2020 when it hit that all-time high. It's not usually a fast mover. So we have actually seen a bit of a blip from gold. If you're used to movements in the crypto world, gold's very staid and conservative compared to that. You're not going to get 20% movements up and down in one day in the yellow metal. So it had a bit of a spurt for a couple of years. It's certainly been having a rest since then. Just to give you a sense of scale, we've got about $11 trillion worth of gold in the world. That's probably, about 5 times, 6 times where we are with crypto at the moment, but it's a tiny fraction compared to stocks and shares, bonds, and real estate. They are measured in the hundreds of trillions. So gold is still a very niche, under-owned asset, albeit, it's worth $11 trillion. So it's possible that we're simply in a consolidation phase. We had a big run up a couple of years ago. Gold's kind of taken a rest. And then at some point, there's going to be some kind of lag. And then people are going to realize that, well, actually, there's no penalty for owning gold now. We've got negative interest rates. We've got negative bond rates. We've got very highly risky stock markets. Let's pile into gold. So maybe that's going to happen any day now. I don't know. I'm not here to make predictions. But also what's happened, if you look at Japan, which has been in a very strange economic situation since 1989, gold has actually held its own in a deflationary phase as well. We tend to think of gold as only being helpful for inflation, but it has actually shown its value in a time of deflation relative to other assets. Obviously, property crashed enormously. Stock markets in Japan still not back to where they were in 1989. Again, this is another message for these kind of technology maximalists who say stock markets can only go one way. That's what they used to say in 1999. In Japan, they were saying that in 1989 in terms of not just the stock market, but their real estate market. And they still haven't got back to where they were after 32 years of it. That's pretty scary. 32 years. And they're still not back to where they were. So if you'd bought the Nikkei in 1989, when you were 35, you could be 67 now and still be underwater. That's how some of these things go. So central banks are buying again. And of course, the gold miners are minting it at the moment because most of them are producing for maybe $500 or $600 an ounce, and they're selling for $1,700 or $1,800 an ounce. So they're having a great time in terms of earnings and profitability, and yet their shares are falling. I think I'm down 20% on my gold mining shares this year at the moment. The analysis I've been able to uncover suggests that we're kind of early in this cycle for miners, because when it's getting hotter, they start going out and buying lots of companies and merging and acquiring and all the rest of it. We're not seeing a lot of M&A in the mining space yet. We're just seeing strong free cash flow. Now, they did get burned last time around. Investors have told them to be much more cautious. So maybe they're just holding tightly onto the purse strings at the moment, accumulating a war chest of cash. And then maybe next year we'll see them go out on the acquisition trail. Because as you know, what kind of happens in the commodities world is when prices are suppressed, there's not enough searching for new stuff. There's not enough mining. There's not enough oil exploration. And then suddenly prices go up again. And it's like, we haven't got enough. Let's go and buy people who've got some. Let's go and buy the promising exploration projects. Let's go and buy these companies that have already got some assets. We haven't quite seen that yet. So maybe that's coming next year. Watch out for that kind of M&A activity as a sign that the market's getting hotter, and you'd assume share prices would start going up because, of course, if they start competing for some of those smaller companies, that's when you start to see some of the amazing returns on these smaller miners. When 3 big boys are trying to buy them, the price just ratchets up incredibly quickly. So the commodities to equities ratio, I'll use this posh word again, is asymmetric. So in other words, the upside to downside risk is much stronger at the moment for gold miners than it is for, say, the tech stocks in the S&P 500. They're already at all-time highs, their yields are at all-time lows. The miners are now highly profitable. They've got cash, which in the real world is still important. So the argument can be made that if you took a 5-year view from here in 2021, you'd think there's more likelihood of these gold miners being successful in the next 5 years than the same tech stocks continuing to reach record highs, continuing with record low yields, and not suffering any kind of pain, correction, crash, or collapse. So that's the argument in favor of having some kind of exposure to the gold miners. At the moment, it's been a bet that hasn't paid off. Here, what you can see, the green line is the S&P 500, and the overall return, which is a combination of increases in share prices plus dividends, has overtaken those of the gold miners. Now, bear in mind, the high tech companies in the S&P are never really that good at dividend payments. What you've seen there is the huge increase in their earnings multiples, and their share price has enabled them to overtake the combination of share price growth and dividends from the miners. So you've got gold miners there in red, you've got silver miners in blue, with a broadly similar pattern that they've followed, but they've been overtaken at the moment. So right now in 2021, it might feel like the S&P 500's a better bet. But if you look if you take it as a forward for a few years and you look at the historic data, maybe we're at some kind of turning point. Maybe this is the cusp of a move from the tech stocks to more commodity-based stocks outperforming. We shall see. One of the arguments I'm hearing a lot is whether cash is now actually being diverted from gold into things like Bitcoin and cryptocurrencies, which are sometimes being referred to as digital gold, or a digital store of value. And I heard a nice expression the other day that commodities are the highway between the old economy and the new economy. Because even in the world of electric vehicles, you need people digging rare earth minerals out the ground somewhere in the center of Africa to make these things actually go. So commodities are always going to be needed. We've got more and more people to feed. We've got more and more things to build, more and more infrastructure. It all needs commodities. So no matter what the technology is, you're building robots, you still need you still need the metal, you still need the plastics, and all the rest of it. And if labor costs are going up, then the technology and the crypto projects could actually have margins falling, and it could start hitting financial assets. If their costs are going up, I talked about them not having invested in technology to grow. If the costs are increasing, then their margins and earnings might decrease, which could have a downward impact on their prices. The data seems to suggest that it's not so much people are selling gold to go and buy Bitcoin, it's that new investors are going into crypto. And from what I can see, very much age-driven. Gold seems to appeal to old farts like me, whereas cryptos very much are in the realm of millennials and Gen Zers. They've brought a lot of new people into the world of investing, but they're not thinking about gold. They're only thinking about Bitcoin. So it doesn't look so much like there's some mass migration from gold to Bitcoin. It's just that new investors are going in there who probably would never have even considered gold in the first place. So it's almost like precious metals themselves have become a contrarian investment. And I always rail against people who have this very maximalist and deterministic approach. I always say, look, it's both and. Diversification is both and. It's not either or. You don't have to choose between gold and cryptos. You have to choose gold and cryptos, but for different reasons. And so a well-diversified portfolio, in my humble opinion, would have gold in it and cryptos in it. And again, it's often a lack of financial education and awareness that makes people become maximalists in one thing and one asset class, rather than realizing that they've got to spread the love around a bit and hold multiple asset classes for all kinds of reasons, including long-term wealth protection. And if you look at gold from a sort of quarterly candles basis, right back to, let's take a 25-year view, you can see that it's still actually at or near all-time highs. You've got to try and ignore the daily noise. if you're watching CNBC every day and you're worried about where the market's gone in the last 3 hours, good luck with that approach. Looking at something like this, you can see that over a 25-year period, gold's been a solid investment, and it's really held its value. It's gone up. It's had a bit of a trough, and now it's back up around all-time highs and could well be poised to go a lot higher in the future. So gold has been delivering. If we take the long-term view, it's only if you take the kind of last 12 months that it's kind of got me scratching my head, wondering why it's not doing more at this specific junction in history with all these other things going on. I'm only guessing that it's some kind of lag, that it's going to take a bit of time for the realization of what's been going on to actually translate. And maybe it's going to need something a bit more catastrophic, like a sudden enormous fall in the stock market to make people realize that perhaps they need some protection, or perhaps people will see in a period of inflation, as their wealth starts to clearly diminish and be eaten away, they'll realize they need something else that's going to preserve that spending power, and maybe that will trigger them into gold. I just thought this was an interesting one to show you. No big point I want to make here. This is just the regional holdings of gold, showing that Western Europe actually has the most, then North America, and then you've got East Asia, Central and Eastern Europe, smaller amounts in the Middle East and Africa, and the rest of Asia. But yeah, I thought it was interesting to see that across the world, Western Europe, if we can call that a single entity, is actually the biggest holder ahead of North America. But if we break this down into more detail, you'll get a clearer view of who's got what. So here's the top 10 national gold reserves in terms of tons. If you look at this column second from the right here, that's probably the most helpful. Gold reserves in tons. So we're over 8,000 tons in America. I don't know when the last audit was done in Fort Knox, so we're relying on their data. So theirs looks reassuringly high. Germany, Italy, and France. I was quite surprised at how high Italy and France are in this league table, and how low China is. But then, can we believe the Chinese figures? Are they understating them? They have certainly been big buyers in the last decade or so. And then Switzerland is the other one that's very much at that top table with 1,000 tons plus. Now, the eagle-eyed amongst you may have noticed a country missing from this chart of the top 10, and that is Grand Britannia. We ain't there. You may remember a prime minister called Gordon Brown, who was obviously a financial and investment genius, and he managed with incredible skill to pinpoint the absolute bottom of the gold bullion market and to sell a huge chunk of Britain's reserves at that very moment. Most investors really struggle to time the tops and bottoms of markets, but Gordon Brown was a genius. And the result of his genius and the lack of action by his successors is that Britain languishes in 17th place in the pecking order of gold reserves, just ahead of Lebanon and behind such global powerhouses as Kazakhstan and Uzbekistan. So it's good to know that, we're in safe hands. We've got a government that knows how to preserve the spending power of the nation, and can really compete on an international stage when it comes to smart financial decisions. Not. But the central banks are buying again. So Hungary and Thailand have added 150 tons in the last 4 months. Serbia said they're going to increase from 36 tons to 50 tons. Turkey, Brazil, the aforementioned Kazakhstan, Poland, and India have all added gold to their reserves. So again, at the same time as they're all printing money, QEing and buying government bonds and debasing currencies and triggering inflation, they are buying gold in their central banks. They are increasing their gold reserves. Remember, it's what they do that matters, not what they say. Australia is actually becoming a significant producer and is catching China. In the first quarter of this year, They produced 74 tons, just slightly under China's 74.4. But they were both actually, their productivity had fallen from Q4. Again, this is probably banana related, but interesting that Australia is catching up in that productivity of gold. But here's a fascinating talk. I talk about these double standards between what politicians do and what they say. There's no stronger example of that in India, which is, been one of the biggest consumer markets for gold in the world. If you look at what they've done in recent months, this is a good attempt to kill demand. They haven't quite gone as far as the Americans did in the 1930s by banning citizens from owning gold, but they've gone almost that far. First, they introduced a sales tax or an increased sales tax and import duties that add 14% to the cost of gold. And guess what that did? It caused a boom in smuggling of gold. So in 12 months, 300 tons of gold has been smuggled into India, which is getting on for half of the 700 tons of legal supply. So, this is one of those unintended consequences when governments start meddling. And they reckon the cost of that smuggling to the government is lost revenue of at least $2.7 billion. So we're back to effectively the Laffer curve here. If you start increasing taxes, smart people will find a way around it one way or the other, including legal and, in this case, illegal methods. Now, all gold jewelry has had to be hallmarked since June. That has caused a 500-day backlog. So you can't buy the stuff until it's hallmarked. They're taking over a year to get it hallmarked. So that just kills supply, which obviously massively reduces the size of the market. And there's also been a banning of stock exchange members from trading what they call digital gold. It's a little bit like something like Bullion Vault or Bullion by Post, where you can buy effectively gold that's held in a reserve, a vault somewhere in secure storage. And they were, I guess, speculating on movements in the price of that gold. That's been banned. So the stock exchange members can't do that anymore. And gold trading has to happen through a single central exchange, which is causing massive bottlenecks. And, India is quite good at bureaucratic bottlenecks. Well, we've got it in the hallmarking process, we've got it in the trading process, and we've got increased taxes and import duties, all designed to suppress demand for gold. And then finally, if that's not enough, they ban the export of gold. So if there was to be an excess of supply in the country, because they are also a gold producer, it can't be exported. So that just causes discounting in prices to try and shift the excess supply. So all of these things manipulating the market in a downwards direction. And yet, at the same time, as they're preventing their citizens from buying anything, what's happening in central bank land? Oh, the Reserve Bank of India is increasing its gold purchases, now in the top 10 of global gold holders with more than 700 tons. Do as I say, not as I do. Interesting. So, given all of the above, what can we not be certain about? Well, I sometimes wonder, I heard this expression the other day, are we actually heading for long economic COVID? Because it ain't going away. We've got anti-lockdown, anti-banana passport protests are continuing to escalate. We've got the situation in Israel, which was one of the best at dishing out the bananas, and now it's having a big problem. We've got bad situation in Australia, which was the most probably vicious in terms of lockdown, possibly only after China. That hasn't worked either. So if lockdown's not working, if bananas are not working, what is it that's actually going to stop this? And more importantly, what are politicians going to do next if there is another hike in all the figures? They love to be seen to do something. Are they going to try and kill the economy again? Or are they going to start treating us like sentient adults and letting us just take reasonable precautions? All to be revealed. Are the travel restrictions going to be coming back in again? They're still as confusing as ever. There's a slight easing of them, but you still hear of people having to quarantine for 14, 21 days and things. So all of these restrictions, are still in place and could even be hiked again. And against all of this uncertainty, Other banks, I know the Fed says they're thinking of tapering sometime next year. Let's believe it when we see it. It's hard to imagine them tightening their policy too much against this uncertain backdrop that is continuing. So what can we be certain about? I believe that the banks, the Fed, and the politicians are going to be much more inflation focused than deflation focused. And certainly there's plenty of inflation around at the moment. So that suggests to me continued attempts to buy treasury bonds and to suppress yields to try and deal with that, and more financial repression as we go forward. But we could suddenly see some deflation as well. And gold has worked in both ways. We think it's a kind of in a consolidation phase and could just be on the cusp of a run up for all the reasons I've stated. Similarly, the gold miners, you have to assume with their record lows and the stock market's record highs, at some point in the next 12 to 18 months, you think there's going to be some kind of mean reversion, some change of direction in favor of commodities. So the question I would ask you today is, what's your current exposure to hard commodities? Have you got any gold or silver in your portfolio? What about other commodities, other metals, other agricultural commodities? There are loads of ETFs and indices you can track for this, or you can get more specific, obviously, and hold individual coins and metals. You can hold them in exchanges like Bullion Vault, Bullion by Post. You can actually have it delivered and keep it either in a safe place at home or in a private safety security box. Please don't go for the ones in the banks. They can be switched off just like ATM machines. And let's not forget the underlying purpose. The reason I always say to have gold in your portfolio, it's not to try and profit from some massive price hike. It's just an insurance policy against financial collapse. We are on a course towards financial collapse. We seem to be locked into it with no obvious way out. Maybe the system will continue to function under this modern monetary theory for some years yet. Who knows? There's no economic evidence of history to support this ending well, but equally, it's an experiment on a scale that's never been done before. So we have no data on how long this could last. All we know for certain is that for 5,000 years, gold has done its job. It's been a store of value. It's been an inflation hedge. It's been a deflation hedge. And there should be some of it in every savvy investor's portfolio. And I'm asking you the question today, have you got any gold in your portfolio? If not, is it time you really thought seriously about putting that situation right? Now, if you would like to go a bit deeper on how to survive and thrive in what I'm calling a financial revolution of the 2020s, there's so much changing, there's so much happening. I would not like to be a conventional bank at the moment, worrying about cryptos, worrying about decentralized finance, worrying about being just completely sidetracked by a whole new revolution. I have a program called Renegade Investor Revolution that goes into a lot more depth about how to survive and thrive in the 2020s. Before you commit to that program, I've recorded an hour-long webinar that you can watch for free at renegadeinvestoracademy.com/playback webinar. Have a look at that, see whether you think that's relevant for you. And I think you'll get some value out of the webinar, even if you don't join the program. I hope you found today's report useful. I'll be back next week with another Renegade Investor Report. And thank you very much for joining me. And I'll see you soon.